So a lot of home buyers, they regret their decision. They didn't realize it when they first bought it, but when they started selling, they realized that number one, either the unit didn't appreciate, and when they start speaking to friends, why is it that their home didn't grow as much or didn't even grow as compared to what their friends own? Number two, some started selling. After 1-2 years, they realized that they're still stuck with the property. There's no demand. And when they want to fetch a certain price, they realize that the bank value just cannot match up to the expectation, even though the next door projects are exceeding the PSF that they're looking for. There are some who had to bite the bullet, cut their losses because they simply couldn't wait anymore, because the next home they're going to buy is just simply going to get more expensive. So they face two bottlenecks. The property is not performing, or it is very difficult to sell and end up losing a lot of opportunities. So we recently had a client who shared with us they've been going to the new launches, going to the show flats, but as long as they couldn't sell their current property, they just couldn't take action on the next one because of those additional tax and of course funds that are locked up in this property. So in this video, I'm going to share with you the 3P property framework that I use to help my clients analyze a project, to use that as a checklist before we even consider a unit in that area. Now this is going to be the first episode of a 10-episode series where I'm going to share with you how you can build a high-performing property portfolio right here in Singapore. If you're new to the channel, welcome. I'm Zoe. I'm a real estate consultant and have helped close to 80 plus families expand their real estate portfolio. The first P in this 3P framework is the purpose. What is the purpose of your property plan? Now, a lot of buyers, homeowners will come to us and say that, look, I want to sell my property or I want to buy a property because number one, I'm looking to rent out. I like this particular project. I like this unit. I'm looking at the layout. I just want to divest and leverage on the banks to make my money grow harder. But all in all, we usually say take a step back and chart out your long-term plan, because once you know where your long-term plan is, then you know exactly what kind of property you should be looking for. So we have this example where we met this client who has been trying to sell his ground floor patio unit with a high ceiling because he felt that he wanted to move into something bigger. He felt that the two-bedder was running out of space, and of course, being on a ground floor, that particular unit was quite close to the swimming pool, so he felt that he needed somewhere quieter. So we sat down with him and instead of jumping into the unit straight away, we started to discuss about first, what age is he right now, and let's plan towards maybe age 54, just before his funds are being tapped into the retirement account, and of course age 65, which is the usual retirement age. Let's chart out the plans. We shared that today, if we sell your property and we buy into something that's performing, just by sheer inflation of 3%, even with him not doing anything, the property would have risen in value by sheer inflation, not even including any boost from the economy or the demand of his home. By the time he's 54, he would have a certain level of wealth that he can, if he chooses to take a step back, do an early retirement to enjoy life, he could actually just sell the property and cash out, fully pay up either a HDB or a smaller condo, the rest put in dividend play, something safe, put into something for travel. If he, let's say for example, he's happy working and wants to work another 10 more years to 65, he can still choose to do so and just let the property grow on its own up to age 65 and do the same thing. But of course, this is assuming that he's just pivoting into the next property and just holding it long term. We have not even talked about, let's say for example, 8 to 9 years down the road, he can still pivot another time before he reaches his retirement age. Because he's right now the youngest that he will get, loan-wise, the banks would be able to lend him the maximum. And of course, when it comes to work, being at a very prime age, there'll be promotion, you have the ability to work harder. So usually if he wants to pivot, this would be the good time to pivot into something bigger, and he could do a few rounds. So at the end of the day, you want to have a long-term goal in mind so that you know that when you want to pivot into something else, you can pivot easily without having to hold or being stuck at the property for a long time, missing out on all the opportunities. That will inform you of your long-term plans, and rather than seeing the property as just looking at the next step, just looking at the project. but rather to project into the future. Now, number 2, P stands for price. We want to make sure that we're entering a safe entry price, that we are not overpaying, because the moment you are paying more than what the market currently is valuing at, if everyone is buying at this level and you're buying this level, then you need to wait for the market to rise to your level, you break even, then you can see profit, which means that it's going to take a longer time as compared to what your neighbors have already bought. This is another case study of a client that we have been helping to secure or to hunt for the home. We have already sold their 2-bedder and they are looking for a 3-bedder because of family needs. They just needed space. So we actually went through with them a tabletop discussion. We went through the plan, the purpose, and they could see that they want to chart out their property plans such that after the youngest one have enrolled in the primary one, they might want to pivot into something else to hold the value or to see more appreciation. So based on what they could afford now, we optimize. In pricing, there are 8 categories of things that I personally look out for. So number 1, to have a benchmark pricing of what is in the outskirts area first. So first, we sifted out the 3-bedders in the outskirts region, that's near the MRT. That gives us a benchmark price. Because if, let's say for example, if there is a core central region home that is similar price to the outside core central, then this shows me there's value in this particular unit that's in the city center. So number 2, then I also look at what's the pricing within that condo, whether has it been transacted. If not, I give a plus 5% buffer, which is what we did. Number 3, then we look at the pricing around the condo. We want to make sure that not only are we not overpaying, but for the similar size, similar type, similar floor level if possible, is the PSF something that is already transacted in the area. Of course, then I also take a step further to look at the performance of the condo. I want to see upward trend graphs. I want to see sellers who are confident, happy to sell, not just in this project, but surrounding, because it tells you that area has demand. You want to be in a growth zone. So basically, we don't know how the market will trend, but we want to stack the odds in our favor. Number 6, I also look at the pricing nearer to amenities, nearer to MRT, so that I know that there is a gap between what I'm buying with whatever that's close to MRT. If it's too close, I might as well consider one that's closer to MRT. Then I also look at the new launches that's upcoming or have already launched. I want to see the pricing. I want to see a gap. If there's a 5 to 10% gap, that is good. Meaning to say that I am not paying the same price as what a new launch is, then I might as well go for a new launch. I will then project, if this new launch is selling at this price, then likely the sellers, when it TOP, they're going to ask for a higher price. Where I'm asking for the same price is something that the market can accept or has already been transacted. And of course, finally, before I pull the trigger, then I ask myself, for this current quantum I'm looking at, can I find something even better in the entire Singapore? In terms of location, in terms of growth. If not, then I know that I'm optimizing my funds. So if you find this useful, do hit the like and subscribe button for more of such videos. Feel free to reach out to me via email if you want to partner with me to help you chart your property portfolio. The last P is potential, meaning to say the resale potential. Because today you're a buyer, you will eventually be a seller. So you want to think ahead. When you want to sell, is it going to be easy to sell? Are you holding a product that's going to help you in your long-term plan, or is it going to be something that's going to stumble you? If this is something that you're going to pivot into, then buy something that the mass market is looking for. Nothing too niche, because the layout is not very common. Then you will need time for that particular group of buyers to put in an offer or to like the place. It has got to do with the timeline. But if, let's say for example, you're very clear this is not going to be a forever home, you want to pivot to something else, or you want that option to come easy, then you want to make sure that whatever product that you buy today, in terms of size, in terms of layout, not only are you catering to family profiles who are more willing to stretch the budget, but also layout types that is able to give you that proper bedroom or sufficient number of bedrooms. I also look at the facing. Are there any facings that I cannot change? I want to try to eliminate that, so that, because that becomes my obstacle when I sell in future. Of course, then I look at the rentability. What are my competition in the area? Is it convenient enough for tenants to enjoy the place? Keep in mind, when you're buying a larger unit, usually the rental yield is on the lower side as compared to smaller units, typically because of the purchase price. We say that there are 2 engines, either for capital appreciation or rental yield, and we always say that if you're buying for own stay and this is your pivot home, go for capital appreciation. But if, let's say for example, you are a retiree and you're looking more for rental yield, as a pocket money because you're slowing down, and then you can focus on the rental yield. Then we look at MRT proximity. Now with the very extensive MRT plans, it's very hard to find a condo that is not near the MRT. But you also see the price disparity. Definitely those closer to MRT will be a bit more on a higher side, but that's also because the demand has pushed up the price. Essentially, what you want to do is find something as close to convenience, as close to MRT as possible within a safe price. And lastly, we take a look at whether or not it is close to school, so that we want to reach out to future family profiles. A lot of parents want to buy near schools, and in order just to be within 1 to 2 km of that particular school, they will stretch their budget. So we want to make sure that our home is able to cater to that profile as well. And of course, balanced lease. If you're an area of a lot of freehold, then we try to go for freehold unit types, because buyers in future will then compare a 99-year versus a freehold in the area. But of course, if you're in an area of 99-year, then it just boils back down to whether whatever they're holding, does it cater to a larger pool of audience who can take more loan? Because as the lease reduces, buyers of certain age will not be able to take the full loan, and that reduces your buyer pool, and that reduces your exit, which means that opportunity cost for you involved. And of course, I will also take a look at what is upcoming in terms of the transformation. Are there new condos that's going to be built there that will push up the price? Are there new developments that more connectivity, more demand to the place, more lifestyle options? That will help me to know whether that particular area is it a growth district. Lastly, I will take a look at whether or not this product type is rare. Is it like a collector's item? Because this will then tell me that, if it is, then I can ask for a higher premium. But of course, that also means that you might need to pay for a higher premium here as well. So this is a 3P framework that I use to help my clients decide whether or not to pull the trigger on the project. And of course, there are deeper conversations than this. Feel free to use them to analyze your project. Otherwise, reach out to me if you require any more personalized guidance and roadmap for your property journey. Do look out for episode 2 that's coming up next.